Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from One News on the 28th of May, banks lower interest rates as Reserve Bank cuts OCR again. Topic number two from RNZ on the 29th of May, are credit card reward schemes worth it? Topic number three from Good Returns on the 28th of May, first home buyers outgun investors again. Topic number four from interest.co.nz, 29th of May, residential construction continues to decline in Auckland and still has some way to go before it hits the bottom. Topic number five from interest.co.nz on the 29th of May, ANZ Property Focus report says ample supply of homes for sale is keeping a lid on prices and expects mortgage rates to bottom out around the end of the year. The links to all of the articles of interest for this week are in the show notes below. So first up from One News on the 28th of May, banks lower interest rates as Reserve Bank cuts the OCR again. The Reserve Bank has lowered the official cash rate, the OCR, by 25 basis points down to 3.25%. That's its lowest level since October 2022. This marks the third OCR decision of 2025 and the first since the budget release. The cut, which was widely anticipated amid global market turbulence linked to the US tariff uncertainty, comes as the New Zealand economy shows early signs of recovery after last year's contraction. Major banks had already begun trimming rates ahead of the announcement. BNZ led the way, with Westpac and others quickly following. Westpac's special fixed rates now sit at 4.95 for terms from 1 to 3 years. ANZ dropped its floating rate to 6.49, while ASB lowered its variable rate to 6.44% and its Back My Build product to 3.99%. Finance Minister Nicola Willis noted that the OCR has fallen 2.25% in 9 months and said about half of mortgages are due for refixing after June. This, she added, will ease pressure on households and could stimulate local spending, benefiting both homeowners and businesses. She also highlighted improved affordability for first home buyers. The Reserve Bank had considered holding the OCR at 3.5% to assess policy uncertainty, but ultimately voted 5-1 in favour of the cut. It cited low inflation, declining wage growth, and spare economic capacity as key reasons. The bank warned that rising US tariffs could dampen demand for NZ exports, especially from Asia, and weigh on domestic growth. While global uncertainty is expected to lower inflation pressure, the bank said future policy will depend on how these risks evolve. Cotality New Zealand Chief Economist Kelvin Davidson said that the rate cut is unlikely to dramatically shift housing trends. Some banks had already lowered rates, and while further competition is possible, the steepest drops may be over. He noted the Reserve Bank expects house prices to rise 3.5% in 2025 and 4.8% in 2026, a view that Cotality shares. Davidson said lower mortgage rates will support prices, but weak economic growth and looming debt-to-income rules may limit the pace of recovery. Topic number two from RNZ on the 29th of May, are credit card reward schemes worth it? Credit card reward programs in New Zealand are expected to shrink further due to ongoing regulatory pressure on interchange fees, according to Consumer New Zealand. However, the organisation says most of these schemes already offer little value to the average consumer. This week, Kiwibank and Air New Zealand announced the end of their partnership, with Kiwibank discontinuing its AirPoints credit card. The bank cited increasing regulation of interchange fees, the charges paid by the Merchants Bank to the card issuer, as a key factor. The Commerce Commission has already implemented standards that led to reduced fees and a scaling back of rewards in 2022. Further cuts are anticipated by year's end. Consumer New Zealand's analysis found that credit card rewards mainly benefit high spenders who clear their balances monthly. On average, consumers need to spend around $25,000 over 2 years and avoid interest charges just to break even on the card fees. As a result, low spenders and those carrying interest-bearing debt effectively subsidise more affluent cardholders. The organisation supports interchange regulation, even if it results in reduced rewards or increased card fees, as it aims to create a fairer system. It also noted that lower interchange fees should, in theory, reduce merchant costs and consumer surcharges, although it warned that savings are not always passed on. Consumer New Zealand has long advocated for surcharge regulation, which the Commerce Commission is expected to consider later this year. Claire Matthews, a banking expert at Massey University, said reduced interchange fees would naturally lead to pared-back rewards, as these fees have traditionally funded such programs. The impact, she noted, would depend on how fee caps are set and shared between financial parties. My thoughts on this are that reward programs with credit cards tend to look quite attractive, but when you dig deeper, you can generally do better elsewhere. Want to learn more about investing in property? Join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and a financial advisor, and all of our free events are available live and online. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no-obligation phone call with my husband, Paul Roberts, via the website, and that's propertyapprentice.co.nz. Topic number 3 from Good Returns on the 28th of May, first home buyers outgun investors again. For the first time since July last year, first home buyers have outpaced investors in mortgage borrowing, taking out $1.543 billion in April compared to investors' $1.519 billion. This marks a significant rise from April 2023, when investors borrowed $718 million. Despite this shift, the share of total borrowing by investors only slightly declined to 20%. That's the lowest since June last year. Overall, mortgage commitments fell from $8.488 billion in March to $7.579 billion in April, signalling a seasonal slowdown, although seasonally adjusted figures showed the strongest April borrowing in 4 years. Chris Peterson, founder and director of Chris Peterson Mortgages, noted that investor borrowing dropped by $280 million from March, but investors remain active, encouraged by falling interest rates following the first OCR cut in August last year. He explained that investors generally believe house prices have bottomed and that ongoing rate cuts provide confidence, although some acknowledge that the market still faces economic challenges and lower than desired vendor prices. Peterson highlighted that bank turnaround times for mortgage approvals are frustrating investors, sometimes taking up to 20 working days longer than the market peak in 2021. This delay complicates auction bidding and negotiations due to extended finance clauses in contracts. He added that major banks have recently begun recruiting more staff to ease the backlog, reversing previous reluctance. While mortgage borrowing conditions have eased since last year's peak interest rates, affordability is tempered by declining rents in some areas. A further concern is the Reserve Bank's upcoming debt-to-income restrictions, the DTIs, which remain unclear in implementation details. Peterson said some investors with larger portfolios are nearing those limits. Most investors his firm works with are experienced property cycle participants. First-time investors largely remain sidelined, burdened by high leverage and cash flow pressures. Active investors are focusing on regional high-yield properties, including multi-unit homes and renovation projects, prioritising cash flow even when rents don't initially cover the expenses. Major banks typically finance up to 90% of mortgages for standard rental properties, while non-bank lenders serve investors and traders at higher rates at 9.9 to 12%. Peterson expects that an anticipated 0.25% OCR cut will attract more investors, but much will depend on the Reserve Bank's rate trajectory. Some economists predict that the OCR could fall to 2.5%, which would lower test rates and accelerate DTI constraints. Despite limited expected capital and rental growth over the next couple of years, Peterson believes savvy investors will capitalise on opportunities in the current market downturn. And that's certainly what we're seeing with our clients at Property Apprentice as well. We're seeing some really good purchases, some with really strong cash flow as well. So the deals are certainly out there. Long at last, although it will be nice to get capital growth back as well for the ones that have already purchased. Topic number 4 from interest.co.nz on the 29th of May. Residential construction continues to decline in Auckland and still has some way to go before it hits the bottom. While Auckland saw a notable rise in new home completions in March, the broader trend indicates a continuing decline in housing supply. The Auckland Council issued 1,255 code compliance certificates, or CCCs, for new dwellings in March. That's up from 899 in February. CCCs, which confirm building completion, are considered the most reliable measure of actual new housing supply, unlike building consents that signal potential future supply. Despite the March increase, completions were still 27% lower than the 1,728 homes finished in March last year. Monthly completions peaked at 1,949 in October 2023, but have steadily declined since. A more telling measure, the rolling 12-month total of CCCs, peaked at 19,560 for the year ending May 2023, but fell to 16,338 by March 2024. That's a 16.5% decrease, equating to 3,222 fewer new homes annually. Given the ongoing monthly declines, this average is expected to drop further throughout the year. Statistics New Zealand reports 14,650 building consents for new dwellings were issued in Auckland in the 12 months to April, indicating that the current downturn in home completions may persist before stabilising. So if you wonder what this means for the property market, it means that we're unlikely to go into the next boom with a shortage of housing, certainly not an oversupply. But as soon as things turn around on migration side of things, that can change quite rapidly because it obviously takes some time to actually complete developments. Topic number 5 from interest.co.nz on the 29th of May. ANZ Property Focus Report says ample supply of homes for sale is keeping a lid on prices and expects mortgage rates to bottom out around the end of the year. The housing market is beginning to recover, but momentum remains modest, according to ANZ's latest Property Focus Report. The report noted that forward-looking indicators continue to suggest that the market will remain relatively steady, with rising demand largely being matched by an increase in supply. ANZ also observed that a surge in property listings has pushed inventories close to decade highs, with many willing sellers coming forward in recent months. Sales volumes have rebounded by approximately 40% from their cyclical low in early 2023. Historically, such increases in sales activity are often followed by a rise in property prices. However, ANZ warns that for now, the ample supply in the market is tempering any upward pressure on prices. According to the report, more meaningful price increases are expected in the second half of the year once the excess inventory has been worked through. ANZ is forecasting a 4.5% increase in house prices in 2025. On the interest rate front, ANZ economists anticipate that rates will bottom out towards the end of the year. They projected that wholesale interest rates are likely to reach their lowest point around that time, and if mortgage rates move in line with wholesale rates, they too should reach a trough near year end. However, because financial markets have already priced in expected OCR cuts, the report indicated that wholesale rates, and by extension, retail mortgage rates, are unlikely to fall as significantly as the official cash rate itself. ANZ estimated that 1, 2 and 3 year mortgage rates are likely to decline by only 10 to 20 basis points from their current levels. Given this outlook, the bank suggested that short-term fixing could be a wise strategy, noting that fixing for 6 months with a view to refixing for a longer term afterward may be beneficial if rates fall further. My advice is talk to your mortgage advisor about your overall financial position before you look at refixing any mortgages. Ready to navigate New Zealand's evolving housing market with confidence? Join me at one of our free events called How to Succeed with Property Investing. These events are available online so you can gain valuable insights and strategies regardless of where you live in New Zealand. And they're tailored to today's market conditions. Whether you're an experienced investor or just getting started, this free session will equip you with the key tools and insights to make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. In our free events, I'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, go to propertyapprentice.co.nz today and register for one of those free events. If you've already been to one and you'd like to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.